Welcome, everybody. Third episode here of the SJ podcast. This week, myself, Justin Halverson, I'm going to kind of play host here, and I'm joined with Nate, Matt, and Jake, and we're going to be hearing from them, and then we're going to be diving into a roundtable about ESG investing. First, we're going to hear from our friend Nate Jefferson, our personal finance reporter. Looks like Nate, your article this week is titled "Investing Made Easy." To start off here, can you tell us a little bit about that?
Yeah, absolutely. This week I digged a little bit into ETFs, particularly, that was a struggle because a lot of people are digging into the stock market, right? They want to invest into individual stocks to grow their wealth. I mean, the stock market is known for being one of the largest vehicles of creating wealth, but knowing that investing into individual stocks is pretty hard. You have to do a lot of things to make sure you're investing into the right things to see the right returns. And so what I focused on this week is the best way to invest your money if you're not that experienced or knowledgeable with investing. And particularly, I dig into how to invest and particularly what is investing into ETFs, also known as exchange traded funds.
So what do exchange traded funds do, Nate? Can you tell us a little bit about them and why we should be investing in them?
Yeah. So just think of ETFs as a basket of stocks, right? So instead of one single stock, you have a whole basket of stocks. Now, these stocks can typically mirror a market or another index, just so you are able to diversify some of your risk. Now, when it comes to owning an ETF, it's not similar to a stock. So when you own a share of a company, you own a piece of that company. When it comes to the ETF, you're not owning any of the shares within that ETF. You're actually owning the ETF itself. So now you're asking yourself, okay, so how is the ETF managed? Well, there's a manager that picks and chooses what stocks he feels like will be able to give this ETF the best performance. From there, you can dictate whether or not this is the right investment for you.
Awesome. So I know this week we kind of want to take a little bit of time to dive into everybody's story too. So I'm reading here, and I want to know, Nate, a little bit more about the managers. Like, what do they do as a manager? So if I was an ETF manager, what's my job? What am I doing, man? You were talking about picking stocks, but what are the stocks? What are the stocks that I'm picking?
Yeah, so it's all based around what the fund is supposed to replicate. Now, I talked about it replicating markets, but it can also replicate specific investments like bonds or commodities. So it's all about what the goal of the manager is. And then from there, you can dictate whether or not the manager's goals align with yours.
Yeah, Nate, I have a question. With so many ETFs out there, it can feel overwhelming to select one that fits your investment strategy. This may seem like a loaded question, but how do you choose an ETF that fits your investment strategy?
One thing I would say for me personally, I look at the ETFs that one are aligning with some of my values. So things that I'm looking for within a company, whether or not they're trying to reach targets within a specific demographic while doing that in an ethical way. Some of the intricate details that I dig into personally, but when it comes to performance and what you're investing into in particular, you might want to look at whether or not the market matches the market that you want to invest in, whether the stocks are something you believe might be profitable in the future. I see it as investing into individual stocks, but not really choosing all the stocks that you want to invest in, just understanding a specific industry that you want to get into. And then from there, trying to maneuver your way into finding an ETF that mirrors that.
Awesome. Nate, I got one more question here for you. So if I was an individual investor and I decided that I wanted to buy some ETFs, where would you say I should get started?
Yeah, well, there's an ETF called, it's three letters for the abbreviation is SPY, also known as SPIDER. Now, this is an ETF that mirrors the S&P 500. And what the S&P 500 is 500 of some of the best companies just grouped together in one index, right? And so what the ETF does is mirrors that index. And so typically when you hear about the market and people trying to beat market. It's in reference typically to the S&P 500, along with a few other indices. Now, in order to see returns, a lot of people try to beat the market, but instead of trying to beating the market, you have to be very knowledgeable. So instead of doing that, it's best just to invest in the market. And you can do that by investing into the S&P 500 ETF. And with that, you're probably going to see about a 6 to 8% return each year. So that's the best bet I would do if I were you.
Awesome. Thanks so much, Nate. So if you guys want to check out more in Nate's story, be sure to check out the Spartan Journal blog on the WMA website. So next we've got Matt Mancini up. So I see, Matt, this week you did a couple top earnings report on Disney and Wells Fargo. Do you want to get us started and talk about those?
Yeah, so Wells Fargo and Disney, they had really interesting earnings for the past couple of weeks. So Disney ended up having their earnings report released on Thursday, and they beat estimates. They got their estimates for their earnings per share was 32 cents, but they actually got 43 cents, which was beating estimates, and that's according to Investopedia. But although they had good earnings, and they also had great subscribers to their Disney Plus service as of January 2nd. And Disney Plus is a huge competitor with Netflix and Prime Video and also Apple TV. So it's a pretty young service, just coming out in 2019, and it's already competing against these huge heavyweights. But despite that, they actually had their stock fall because some investors think that there's too much optimism within this Disney Plus. But we'll wait to see what happens. That was only on Friday, so we'll see. And then with Wells Fargo actually did a little bit better for their earnings per share, which was 64 cents compared to estimates of 59 cents. But they actually generated much less profit. They were down 83% from 2019. And they also had an 80% reduction in their dividend, which is pretty interesting because they also were able to go against stress tests by the Fed, which is basically a stress test is when the Federal Reserve does stuff with banks where they test whether or not there's a recession, whether or not the banks can actually withhold it. And Wells Fargo actually performed pretty well with that. They have a lot of capital on reserves, and they're also able to do some cost-cutting initiatives. So Wells Fargo, their stock went down, but they're still a pretty well-valued company, as well as Disney. So this isn't a recommendation or a valuation. This is kind of just from basic news.
So were you surprised? I guess I know, let me back up. I know I was surprised that Disney performed so well. Like Disney Plus seems to be just, I don't know, knocking it out of the park. Like they haven't been around that long. And it's amazing to me that Disney Plus beat earnings with having all their big theme parks closed. So I don't know, Matt, do you have any thoughts about that? Is that surprising to see them beat expectations?
Yeah, they were actually at limited capacity for their parks. So I think they went down, it was like 53% for their parks revenue. And they also have a lot less earnings because they aren't able to produce that many movies. Their production company's down because obviously people can't meet in person for COVID-19. So I was a bit surprised. I think Disney Plus kind of just shoots it out of the park, and then the parks in themselves don't necessarily matter that much. So
Yeah, Matt, I noticed in your article, it says that Disney is 26% growth average monthly revenue per paid subscriber, and I was looking more into what Disney's doing, and they recently in September, they released a new program called the Disney Plus Premier Access Program, which is where they released the live blockbuster Mulan. That film was pulled from the theatrical run and placed on Disney Plus instead, where subscribers could pay a fee to watch it. What began as like a one-off approach started to become more common as the lockdowns continued. Disney Plus Premiere goes some ways towards recreating the cinematic experience that we can't get from, theaters. The brand new titles that Walt Disney Studios made on Disney Plus are becoming more relevant day in, day out. meaning you can enjoy them from the comfort of your own home. Do you guys see this, this increase in, Disney Plus, Hulu, Apple releasing their own, series continuing?
Oh yeah, I completely see it. I've been a huge advocate because think about it. If you're a family with a mother, a father, and 2 kids, you spend $9 going to the movie theaters just for the tickets, plus popcorn and snacks and drinks. You're spending $60 just to go to the movie theater for one movie, seeing the movie one time, versus renting it or doing this premiere access, and it's like what, $30, and you can watch it multiple times. I think you rent it for like a few days, so it's definitely a better bang for your buck, and I think that it's going to become industry standard. It's unfortunate because you have these companies, AMC and a bunch of these big movie theaters that are kind of going out of business. So that's the unfortunate aspect. But I definitely think it's going to become more standardized where you just release these big movies on streaming platforms.
Yeah, one thing I won't miss is paying $20 for a bucket of popcorn. I'll tell you that.
Yeah. But what I don't think they can replace is the movie theater experience. Like, you have the midnight showings, you have going into that big place, and I don't think that can necessarily be replaced. I think there's definitely still going to be movie theaters, but just not as many.
Something interesting I've heard, now this is pure speculation, but I've heard that like Netflix, a lot of people have been calling for Netflix to buy AMC and to buy some of these big aging brands that own movie theaters, because like you're saying, Matt, like everybody, I want the movie theater experience. I can't wait to go watch some, badass movie on IMAX. Like, I can't get that in the comfort of my own home, but yeah, like the convenience aspect isn't going away at all. So
yeah.
Sweet. So Jake, we're going to move on here. So Jake, I know this week it looks like you were writing about life insurance, and it seems like the pandemic has prompted more younger people to buy it. So kicking it over to you, man. What's that all about?
Yeah, thanks, Justin. So that's right. So the pandemic has recently encouraged younger buyers to get into term life insurance. So applications for life insurance policies soared 4% in the US in 2020, which is the highest year-over-year annual growth rate since 2001, when they started tracking this activity. The deaths from COVID-19 encouraged many young people who previously neglected buying life insurance to finally then take action. These many Americans made purchases to replace or add to their employer-provided coverage. Due to the current state of the economy, they could lose their job, they could get laid off, and they could lose their coverage. And I really like to quote from this Northwestern Mutual advisor in San Diego. She said, the silver lining of the year was that it did help people realize they needed to prioritize planning for the worst days as well as the best days. You never know when you're going to need this life insurance. A lot of these term life insurance policies, 30 years, you never know when you're going to die. So it's always a smart move to do it before the curve. The industry sales growth increased despite some life insurers turning away business by suspending sales of certain types of policies. And these decisions were linked to March drop in already low interest rates, because these insurers put a lot of their premiums into bonds. So I just want to go over a couple statistics that the Medical Information Bureau has put out. They saw 7.9% growth for applications under 45 compared to 3.8% increase for consumers 45 to 59. So this means millennials are, getting ahead of buying this life insurance. The younger policyholders were generally favoring this term life insurance policy, which provides death benefit for a period of up to 30 years. And I was looking more into, what were these buyers typically buying into? And I was looking at Lincoln National, and they normally a buyer purchases a 20-year, $500,000 policy costing around $350 annually, which is pretty much the base price for these policies. And Lincoln's term life applications were up 25% year over year through September for buyers under 40. And for the month of December of 2020, It was the best returns for New York Life, with double-digit percentage increase in both number of life insurance policies sold, and it was new sales premiums. So we're just seeing a big skyrocket in the number of term life policies that are being bought.
I know we got a couple.
Yeah, so
Oh, sorry, Matt. Go ahead. I was just going to say we got a couple of veterans of the life insurance industry here. So what do you guys think about that?
I was just gonna say, I know Nate also worked in it. I worked for New York Life this past summer, and I can definitely say that we had a lot more people that were just worrying about death. I mean, you have death all around you from the COVID pandemic, so people were trying to sign up. And I also would suggest that people younger would only go into a term life policy, because some insurance companies, they're going to want to try to get you into a whole life policy, which the difference between a term life and a whole life is term is only for 10 years, 20 years, versus whole life is throughout your whole life. And the whole life policy, yeah, you'll get a higher death benefit, but you're going to be paying way more annually. And as a young college kid, our only expenses are really our college debt. And a $2 million policy, like what are our parents going to do with $2 million after we die? Like it's kind of just, it's kind of useless. So I think that term life is definitely the way to go. I mean, I have a term life policy, so I think that it's definitely a good investment. And people need life insurance. It's definitely something that it's a necessity for some people.
Yeah, I second everything you just said there, Matt. Again, I'll make sure I restate it again. They will try to push a whole life policy on you. So you have to be aware that you do not want this. I mean, at the end of the day, if you do want $2 million in your parents' bank account, then so be it, get them paid. Props to you. But for me, I'm a broke kid, can't really steep to those levels. So I'm gonna get a term life policy. Now you can get 10, 20, 30 years. It's all based around what you feel like your needs are, whether you feel like you'll need it for a set period of time until you get a specific job, or until maybe you got kids right now, like we don't really know your situation, until they grow up, then you'd be able to no longer need the policy, like things like that. It all aligns to your specific preferences. But at the end of the day, it's an investment into yourself for your well-being and whoever is looking after all your I guess all your payments of debt when you're gone, helping to make sure that they can cover all those things as well.
Yeah, and I want to go a little more in depth of what exactly term life insurance is compared to the other types of insurances. So term life is a type of insurance that guarantees the payment of a stated death benefit if the covered person dies during a specified term. And once the term expires, the policyholder can either renew it for another term, which then increases the premium, or convert the policy to permanent coverage, or allow the term life insurance policy to terminate completely. This term life insurance is then attractive to young people with children. Parents may obtain large amounts of coverage for, reasonably low costs. And upon the death of a parent, the significant benefit of this lost income that they lose from, the death of a loved one. These policies are well suited for people who temporarily need specific amounts of life insurance. And for example, the policy holder may calculate by the time of the policy expires, their survivors will no longer need the extra financial protection because they will then have enough assets to then insure themselves. And I want to go into a brief example of what term life insurance is. So I have a brief, story here. So 30-year-old George wants to protect his family in an unlikely event of his early death. He buys a $500K 10-year term life insurance policy with a premium of $50 per month. If George dies within the 10-year term, the policy will pay George's beneficiary $500,000. If he dies after he turns 40, when the policy has expired, his beneficiary will receive no benefit. And if he renews his policy, the premiums will then be higher, and his initial policy, because they're based on his age of 40 instead of 30. And I was looking more into this, if you renew your term again, if you get a terminal illness in your first term, you're not able to qualify for a second term unless you pay like substantial premiums on top of that. So that's another cost to it as well.
Awesome. Thanks, Jake. I know insurance is one of those things, especially as college students, that I'll just state it can be boring, but it's necessary. And not only can it be a little boring, but because we don't want to learn about it, it can be daunting. So this has been great. I love that example, Jake. I know something I learned in the wealth management class, in our insurance class, is that you can start with a term policy, you can pay into it, you can eventually roll it into a whole life policy when that time comes. So I know that there are policies, term life policies out there, like you guys are saying. So awesome. So I want to switch gears here, and I want to move it on to a roundtable discussion on ESG investing. So I'll just kick things off here by saying ESG investing, environmental, social, and governance. So us newer investors, the new generation, we're investing behind our values, and we've seen ESG investing become a lot more popular. So environmental, that's when you look at if a company is paying attention to climate change and what they're doing, focusing on the earth. S means social, so that means looking at what they're doing in their community. Are they helping out their local community? Are they donating to charity? And then G is governance. So the corporate structure, is it fair? Are they paying their CEOs a fair wage, so to speak? And are they treating their employees right? So that's a little bit of background for anybody not familiar. Like I said, I know it's becoming more popular. We all did our homework here. So I just want to open the floor to you guys. What are you guys' thoughts on ESG investing?
Yeah, I've had a fun time doing my research on this. Just with us being millennials and Zers, we're a lot more aware of our environments and how we're impacting it. So whether that's the actual environment, whether that's the earth, or whether that's socially, we understand our impact and influence on that. Previously, we were only investing in companies based on how they could perform for us from a financial standpoint. Now we're able to do that and also invest inside the company's morals. And that's something we haven't seen before. I mean, at the end of the day, we usually just stick to this tunnel vision mindset that, hey, we got to get into the companies that have the best return. But now we have an opportunity to do that while investing into companies that have the same morals and values as us. And I feel like this is going to be something that 10 years down the line might just change the game.
Yeah, I completely agree. I think that, and investors agree too. I mean, ESG investing has skyrocketed over the past 5 years. I think it's doubled just within the past year. And it's pretty incredible because you have these institutional investors that are super into ESG investing, and mainly because they're making a difference. I mean, you have the Biden's policies where he's trying to boost the environment and make people more conscious of their carbon footprint and stuff like that. So ESG investing, I think, is just going to continue to grow, and it's going to continue to be something that people really want to invest in.
Yes, so I looked more into what these wealth management companies are doing to stay ahead of the curve with this ESG format. So I looked into BlackRock, which is the largest asset manager. And they're based out of New York. And in 2019, they released a blueprint pretty much of how they are investing in ESG. As long-term investors, accounting for environmental, social, and governance risks and opportunities help provide sustainable value to their clients. And so in 2019, the CEO, Larry Fink, sent out this blueprint to 60 other CEOs and chairmen of some of the largest corporations in the world. And he was referring to striving for more stable returns in the face of a fundamental reshape of the markets, which is sustainably has become a critical factor in determining companies' long-term value nowadays. So I like to focus on three main aspects that ESG has integrated into their efforts. So there's three main themes. There's investment processes, material insights, and transparency. So the first one, in investment processes. So in 2020, BlackRock raised the bar for how investment teams will accomplish this. All their active funds and advisory strategies are expected to fully integrate ESG, meaning that one, each strategy has a description of how ESG fits into the investment process. Two, portfolio managers are accountable for managing exposure to material ESG risks. And three, investment teams are able to provide evidence of how ESG considerations inform investment decisions in each portfolio. So the second one is material insights. So for the public market strategies, BlackRock is continuously expanding their ESG data sources through Aladdin, which is their core risk management investing technology. So Aladdin is an end-to-end operating system for investment professionals to seek out their whole portfolio and understand their risk exposure and how they're going to act. And today, BlackRock investors have access to two broad third-party data sets across Aladdin and 10 unique ESG data providers across different parts of the research. This data ranges from broad ESG scores and rankings to indicators in physical climate risk, risk of employee sentiment. And in addition to third-party data, they've developed proprietary measurements for tools to deepen the investor's understanding of how ESG, is shaping. And the last one is transparency. I'll make this one pretty quick, but investors at BlackRock believe wealth management companies balance business relevant ESG issues alongside the traditional financial objectives that were, relevant in the early 2000s. Consistent with this expectation, they strive to provide market-leading transparency for how they incorporate ESG into investment products. And with respect to transparency at BlackRock, the investors are able to access clear information on the sustainability risks for their investments. And for example, they provide data on websites for all the iShare funds, displaying ESG scores and their carbon footprints, among other measurements. And in the second half of 2020, they're extending this practice to all BlackRock mutual funds, including disclosures on exposure to sustainability characteristics. That was a mouthful. Sorry, guys.
Yeah. It's funny that you mentioned BlackRock, because when I was doing some research about BlackRock a couple months ago, and if you look up their Wikipedia page, like first thing it says, it's biggest shadow bank, known as like the biggest shadow bank in the world. And it's kind of funny that that they're investing in ESG funds, because they've been notorious for influencing policy and stuff in the past. And I think that, it's a term called where they're trying to be conscious capitalists, where instead of investing in companies that like let's say a gold company that does some questionable stuff in Africa where with labor practices, instead of investing in one of those companies, they invest in an environmentally friendly company. Like, regardless, they're putting their money into something and investing policy, which may or may not be ethical, but regardless, they're doing it for a good purpose. So you have to give them some props for that, because at least they're making a difference that is going to help humanity and make things better. And I think that I implore BlackRock for doing that, and I hope they continue in the future.
I haven't heard of, did you say conscious capitalism? Like, I never heard of that before until you said something, but
yeah. I looked it up in a Forbes article, and it's pretty interesting. It has it's very similar to ESG, where you look at all of these different factors. It's a lot more into like culture and leadership, but it's pretty similar to ESG.
Now, I know BlackRock was also looking into getting into Bitcoin. I don't know if they made any headway into that. Do you guys know anything about that? Because that kind of goes with that same concept with investing into the future, investing into where we believe this generation might be going, specifically regarding blockchain technology. Like, that's going to be huge, and investing into something that has the brand now, i.e. Bitcoin, will allow them to be ahead of the game once that time actually comes for us to be able to use it on a global scale.
Yeah, Nate, so I'm actually looking at this article right now, and it's saying that BlackRock has given 2 funds the go-ahead to invest in Bitcoin futures.
Crazy.
So they are. And this was in early January, so not too long ago.
Wow.
On Friday, I just want to jump in. The oldest bank in the United States, I think it's Carnegie Mellon Bank, announced that they're going to be buying Bitcoin. We can't turn this into a Bitcoin show all the time, but it is pretty crazy.
But it's on our minds, man. But that just goes to show you that we're starting to see a lot more that people are making their way into more of the future, not just future returns, but how civilization might be functioning in the future. Now, we understand that blockchain has a lot to do with it, but we'll make our way back to the ESG conversation. So, Justin, did you have anything to add into the conversation about that?
I mean, it's interesting. So I think, Matt, you threw out a stat that they were doubled. The stat I found was like the most recent ESG. It's like there's 11.6 trillion in assets according to the ESG criterion. So the only thing I wanted to add in here that I don't think we've explicitly said is what most companies do. And here's something that we should find interesting is there isn't a universal ESG screening. So there are companies out there that they explicitly screen for companies, but we're talking about BlackRock, we're talking, if we're talking about Vanguard or Charles Schwab, they do have these ESG components, but what each company does to evaluate the different criteria are a little bit different. So it's going to be really interesting to see how things move on, because like you guys are talking about values. So for me as an investor's perspective, I have my set of values. But if I'm looking for a fund, like you're talking about a gold mine, the criteria that Charles Schwab and Vanguard and BlackRock might use might all be different. So I just want to insert in here that it's very important right now, while this is a new phenomenon, for all of us to be aware that everybody uses it a little bit different. I saw that the U.S. Labor Department, they issued a new regulation in 2020 it was revised to remove explicit references to ESG factors for wealth managers. So what this means is any fiduciaries who are acting in a fiduciary capacity on a retirement plan, they have to choose a retirement plan strictly on how well those strategies perform financially. So I'm a little long-winded too here, but the reason I'm also saying that is traditionally these funds don't actually seem to perform that well. So I don't know if anybody had any thoughts about that, because it's a brand new industry and it's ever changing.
Yeah, I was under the impression that that the people that invest in ESG tech stocks were actually performing above like the market.
Yeah,
but that was
that's what I saw too.
Tech stock.
So like I'm saying, you guys will just, what's the screen? So that's what I'm getting at here. Cause like if you're looking at like buckets on a whole, ESG screening typically does underperform the market, but there of course are sectors of the ESG screens that do well. So I guess that's a better way of explaining my point. But
I think it's more like which ESG you invest in. Like,
go ahead, Matt.
No, I mean, I was just going to say, like, I feel like it's like which fund you invest in for ESG. Cause like some of them might be based off like Justin was saying, like Morningstar research versus Bloomberg research, like which research are you getting it from? And I feel like that's kind of the basis of it.
Yeah, and I see a lot of the articles talking about ESG specifically as another risk evaluation, just to see what a company is doing from a risk standpoint that'll make it viable to be a successful investment for the long term. Like I believe they came up with an example that if the company is doing a lot of things to promote a positive carbon footprint, whether that's in the materials for their inputs when it comes to producing goods, or that's in their products, people are more inclined to gravitate towards that business, just because they understand doing business with them will also help the carbon footprint of the environment. And so it feels like we talked about it last week, just that feel good purchase. So not only does that help the feel good purchase for the customer, but it helps the company when it comes to bringing in more customers and showing that their brand stands out because it takes care of what the customers are originally buying the product for, but also because they're going to that product to also say like, hey, I'm taking care of the earth. Now, when it comes to some factors like of what they measure ESG by, so like they look at, for environmental, it could be based on the company's use of their energy, so their energy efficiency, GHG emissions. I don't know what that is specifically, but I'll do my research on that. But then for social, it's like staff turnover rates, training and qualifications for the employees inside the establishment, maturity of the workforce, things like this, just to help the investor to better understand what they're getting themselves into when investing into this company. And all these factors go into understanding whether or not this might be a viable investment for the long term. So yes, it'll also help you bring positive returns for investing into your morals, but I feel like it's also a risk evaluation just to see how sustainable the company will be for the future. I didn't know if you guys had any thoughts about that.
Yeah, I actually wanted to go over a couple figures that I was looking on this website called the Deloitte Insights, and it was showing a graph of how like the assets that can make up the managed funds in the United States. And in 2012, it was about 11% of the overall professionally managed assets were in ESG. And then by 2018, it was up to more than half at 26%. And they project by 2025, um, almost half of all assets managed will be related to ESG.
Yeah, I believe that. I think moving forward, it's definitely going to be like, who knows, maybe they'll add a Morningstar box and something to that degree to it, because the long-term potential, right? Like investing, we're investors for long-term, or at least I am. And I know that's what I'm going to be advising clients on. So it's definitely important to learn about the sustainability of a company. And that's where ESG, I think, is definitely going to be a big part. So any last thoughts here, guys, before we wrap it up on ESG investing?
I was reading the article and it was pretty bullish about ESG investing, but it said a rating might come out for ESG investing, typical to a credit rating where um, it's required for each company. And they were saying that ESG rating, just based off the value that it brings for the investor, but also what it brings for other companies within that industry, like the incentive just to have a positive ESG rating. It was saying that the ESG rating could be as powerful, if not more powerful, than a credit rating. Now, that's pretty powerful. So I'm looking forward to seeing where this is going to go in about 10 years, just to understand what influence this will have on our investing decisions.
If you enjoyed the discussion, please like and share the podcast on Apple and Spotify. The Spartan Journal podcast is part of Michigan State University's Wealth Management Association, a student organization whose goal is to inspire the next generation of financial advisors. The Spartan Journal news team releases a newsletter every Monday morning comprised of financial literacy and the week's market updates. Feel free to follow us on social media at msuwma and check out our website at msuwma.com.
Anything heard on the MSU WMA podcast is for educational purposes only and should not be considered as investment advice.